saying not a million jobs from this.
I cannot see that. Look, I can promise you, if the economy recovers and China recovers and China does well, our companies will absorb this Eskom price increase. You won't even see it, because the underlying economy, what happens to it, is significantly more important. Of course, if the underlying economy doesn't recover and China falls away, then the Eskom price increases will have a devastating effect. But as long as your top line is growing, you can probably absorb all of it. And as you've spoken about a few other times, you somehow make a plan. If the price of petrol goes up too much, you use your car less. You somehow make a plan, and that's what capitalism's all about, is somehow making do in adverse circumstances and making a plan.
Earlier we were chatting to Peter Attard-Montalto, the emerging market economist at Nomura International, and certainly his stance is that the curbing of credit extension in China is not such going to have such dire consequences on the global economy, specifically on commodities. Simply they're curbing inflation, but at the same time hoping that the economy is going to continue growing 10.7% over the fourth quarter.
No, absolutely. I mean, China's obviously going to continue growing as the middle classes become wealthier, as they need to buy refrigerators and cars, etc. We've always known that. What has happened, I think, is that commodities have somehow got a little bit in advance of the real markets, and you have seen a lot of speculative froth. So I think that speculative froth really, for that froth to be maintained, it needs a constant stream of positive data, and this negative data that's come out recently has sort of upset that a little bit, and a lot of your longs have taken profits, and that's caused a bit of a knock-on effect, I think.
Let's look at the local market. You said that you would take this opportunity as a buying opportunity if we did see pullback. Where specifically, where equities are concerned?
Well, look, I suppose, and it's so difficult to call a number, because the moment you ever call a number, you know you're going to be wrong. But let's say the market pulls back to 25,000. If it did that, we would be strong buyers of equity at that level.
Across the board, industrials,
basically,
financials, and resources.
Look, if the market pulls back, the resources will fall the most. Because they went up the most. So if the market does pull back to there, the banks shouldn't fall a hell of a lot more than what they've fallen already. But the resource shares, the mining shares, platinum will take a complete pounding. So then that's obviously then where you would want to go and buy, should it fall to 25,000.
We recently had an upgrade out of Merrill Lynch on the platinum stocks, and that was based on a platinum price of around about $1,800 an ounce over the next year. They were saying Impala Platinum could go to 275, the likes of Amplats, which is what we want to talk about now, to 1,050. And of course, we're sitting, at just above 800 on Anglo Platinum at the moment.
Yeah, I mean, I don't necessarily look at the shares, but if you just look at the underlying platinum price,
that's what I'm asking you
I think that's, I'm maybe not as bullish, say, as they are. With these ETFs, you've obviously seen a lot of advanced buying in the market to stock up that physical supply that they need. So it's not necessarily going to keep pushing the platinum price up. Look, if we have
correct myself. Anglo Plat, sorry, is at 752 Rand and 36. It's down 3 3/4% today. Apologies to interrupt.
No, I mean, if we have a renewed build out in the environmental sector, for instance, because now we have to replace crude oil, etc. Yeah, sure, you are going to see an increase in platinum, and I would always say that you're going to see that correlation between gold, platinum, and crude oil, and platinum's probably one of the better picks.
We've debated this on the Anglo Plat side.
I've got no problem with the platinum price staying where it is or maybe going up, but the platinum shares are seriously expensive. They've got that price and probably more built into it. I mean, even let's just say the price stays at $1,600 and the rand stays more or less where it is. The forward price earnings ratio of Anglo Plats is still about 50% more than the market. In other words, even taking into 1 year's good earnings growth at a relatively high price of platinum, the PE, the price earnings ratio, is still at a premium to the market. So we're steering clear of the platinum shares.
You've already sold out of platinum shares.
Yes.
You switched into the
Anglo
diversified miners.
Which didn't help us much. But yeah, we went into Anglo Plats and Billiton, yeah.
Oh, you mean Anglo-American?
Anglo-American and Billiton.
Anglo-American and Billiton. And equal exposure across both of those stocks, or more heavily weighted to BHP?
No. It's actually relatively, it's a bit more in BHP, but it's not as much the same, yeah.
Your view on gold, because we need to treat this one separately. There is that emotive element to the yellow metal, and we're trading below that $1,100 an ounce level. Do you think we're going to see a dramatic pullback from these levels?
I think gold's going to stay at these levels. I think you've seen India now getting psychologically comfortable with the fact that it's breached 1,000 and they're prepared to come in and buy now on the dips. But there isn't really no reason for gold to run away unless inflation runs away. And I don't think we're going to see that until we're going to start seeing these interest rate rises. So trying to jump the gun on gold, I think is probably not a great strategy. And to be honest, the speculative froth in the gold market, I think, has gone out a little bit now. It's gone more towards base metals, let's say.
Obviously, the strategy I'm embarking on now is to ask you about the metal price and then translate that into a share price view on gold stocks.
Just before I do that, just one thing we know for sure this year, you know this for sure, no one debates it, there's massive deflation worldwide. The chances of inflation picking up seriously in 2010 is virtually impossible.
Yeah.
Okay, it's virtually impossible. So that we all know. That, I must say, the gold shares, in our view, are not quite as expensive as the platinum shares, but still expensive. I mean, gold has been a very poor investment gold shares has been a very, very poor investment for the last 10 months, an incredibly poor investment.
Despite record high levels
on the rand.
Yeah, but it's the rand that's killed it.
It's the rand gold price that we need to take into account.
It's the rand that's actually hit it. But, you know, should gold shares fall a little bit more, and what's a little bit more, maybe 10, 15, 20% more, we will, for the first time in multiple years,
I was going to say, this is the first time I've ever heard you saying anything close to the fact that you're going to be buying into gold shares.
We'll have a look at it.
Gold is essentially a currency, and effectively when you're buying gold, you're shorting the rand. And I think gold shares actually react probably more to a weaker rand than they do to a stronger gold price. So you really have to bear that in mind.